Good evening, everybody. Thanks very much for joining us again. This week, I want to take a look at commodities, and in particular, natural gas, and how we can apply the MACD indicator to the current backdrop of natural gas and how that's likely to evolve, how we could have used the indicator to highlight trending signals, and what the indicator is actually telling us right this moment. So let's take a look at the MACD and the basics in general. And the moving average convergence divergence is basically what is the MACD. The basic definitions really give us it's a trend following system, and it's basically the gap between two exponential moving averages. Now, on the majority of systems, the default setting is a period of 12 and 26, with a 9-period exponential moving average of the MACD line itself. Now, I tend to adjust this slightly, to shorten term slightly further, and I use 10 and 20-day exponential moving averages together with as the default is, the 9-period smoothing indicator. And basically what this actually shows with the MACD is the gap between the two exponential moving averages. So the red line here is a 10-period moving average. The blue line is the 20-period moving average. And the MACD below, the blue line reflects that gap between those two moving averages. And the red line is a 9-period exponential moving average of the indicator itself. Now, in very simple terms, as that gap widens between the two moving averages, because prices are rising, so the shorter term average follows price activity more closely than the longer term, the gap will increase as prices rise or as prices fall within a downtrend. And this is reflected by a rising MACD indicator, the blue line here. So the indicator itself measures and reflects the gap between two exponential moving averages, giving us a directional trending signal. Now, I use the MACD and its average and the setup of around the zero line to confirm the current trending conditions of the market. Now, it's important to stress that this isn't a timing indicator. Because it's moving average based, even though we're using exponential moving averages, which obviously put greater emphasis on the current data, so in theory do give earlier signals, they are still too slow in giving the types of signals that we're looking for. So we would use other indicators to give us that timing aspect, but we would use the MACD to give us the directional themes and the directional risks within the market. Okay, so how do we use the MACD to highlight the trending conditions of the market? Now, this is a daily chart of natural gas going back to May last year through to October last year. And it just highlights the types of signals that we're looking for. Now, there are basically 4 signals that I will only use the MACD for, and that's to highlight the trending condition of the market: an aggressive uptrend, an aggressive downtrend, or consolidation in either an up or downtrend. And the MACD can give us a very quick and easy reference for this type of indicator. So an aggressive downtrend signal comes when the MACD is below its zero line and below its own moving average. And this is an indication of a more aggressive downside risk within price activity. And you can see that the red circles highlight when we had more aggressive downtrend signals in place. Now, in this type of setup, the risk is that we can carry further and more aggressively within this downtrend until we start to see evidence of a turnaround, either within price activity, from a candlestick reversal, for instance, or we start to see the MACD crossing above its moving average to suggest a more extended consolidation within that move. So that's the aggressive downtrend. For an aggressive uptrend, we're looking for the MACD to be above zero and above its moving average. And again, we've highlighted that with the green arrows. So it's this condition where the market can extend further to the upside as the bullish trending conditions continue to develop within price activity. And it's important to bear that in mind because it gives us a very quick and easy reference as to the trending condition and whether or not we can expect corrections to be limited and price strength within that trend to be more extended and to carry further than the majority of traders are actually thinking, because this is where the potential of greater price movement and price strength is set to be seen. Okay, so that's the aggressive trending signals. How about consolidations within the ongoing trend? Well, this comes again by using the MACD, but by looking at the MACD in relation to the moving average. And if it's below its own moving average, as we've highlighted within the yellow circles, that's when we are seeing consolidations within an uptrend. Now, we know that this is an uptrend because the MACD is still above the zero line. Above zero, you're in a bullish trend. Below zero, you're in a bearish trend. And the relationship with the moving average gives us and allows us to quantify the seriousness and the condition of that trending condition. So basically, the consolidation signals within the MACD are either going to be ended by, as we have in this situation, the MACD crossing back above its moving average while it's above zero, which highlights the aggressive uptrending signal, which we looked at previously, or we start to see the MACD breaking below its zero line to reflect a more aggressive downtrend, which again we looked at recently. So the consolidation allows us to stand aside, if you like, and to see where the next directional risks begin to evolve, and we can reflect that within our trading signal. Now, a consolidation within a downtrend is when the MACD is still below zero, still within a downtrend, but it breaks above the moving average to highlight the consolidation and the potential of it either being a limited consolidation before the downside is resumed, or the MACD breaks back above its zero line to highlight a more aggressive bullish trend and the risks for a more extended move towards higher levels. So by using these four setups, we can see how the trending condition of the market is at any given time. And we can allow that to build within our trading strategy. But again, it's important to stress that the MACD only highlights the trending condition. It doesn't give timing signals because it is slow moving, because it is moving average based. So it's worth bearing that in mind and using something like a momentum indicator to give us fresh signals within the ongoing trend. So if we need to know the trending condition of the market very easily, we can see and look at the MACD, its relationship to the zero line, and also to its moving average, and allow us to actually quantify how aggressive that current trending condition is likely to be. So let's take a look at natural gas now and how the market is actually developing by using the MACD. Well, it's actually at a very interesting stage at the moment because latest recovery moves have seen breaks of above the resistance of the recent highs, but the MACD is now back to its zero line. So this is going to be very important to monitor to highlight whether or not we're starting to see a more positive trend emerging. So we've switched over the last few months from an aggressive downtrend to a consolidation within that downtrend. And now we're watching to see whether or not the MACD can break back above its zero line to highlight a positive trend, or we start to see new price failure and a resumption of what is still a longer-term, more negative trending condition, and if the MACD breaks back below its moving average. So it's fair to say that natural gas is at a very important stage at the moment, and it's certainly something that I'll be watching over the next few days to highlight whether or not we start to see a more aggressive and significant trend change, or we resume what is still the ongoing downtrend. So that's me for this week. Thanks very much for listening.